Welcome, traders, to another Tickmill trading update with me, Patrick Munley. Want to update the SP 500 view using the E-mini futures contract and look at some potential high probability action areas for the trading week ahead, and some price objectives or price targets that we can realistically expect to achieve. Before we jump into the technical picture, as always, want to review the market dynamics, market narratives that are in play, and take a look under the hood as well in terms of some internal indications of where the market's at. So obviously last week was monumental in terms of market activity. The market actually closed the week with one of its best weekly gains in a couple of years. The S&P 500 for the week finished up 5.7%. For the month now, it's only down 4.4%. On the year, we are down 8.8%, and from the all-time highs, we are still in correction territory and trading down just over 12%. In terms of the breadth of the market, remains bearish, really, in terms of the S&P 500 components. Only 20% are trading above their 20-day moving average, only 19% above their 50-day, and only 28% above the 200-day. Obviously, those are improved statistics from the prior week, but they're still net negative. And if we think about the calendar for the week ahead in terms of what we've got on the macro side of things, obviously it's a holiday shortened week, as Friday most of the main market centers are closed, certainly the US and Europe for Good Friday. So the real macro driver outside of obviously tariff headlines will be retail sales due out on Wednesday, and the earnings season gets underway in earnest heading into the mega tech names, and we'll get Netflix after the close on Thursday. We have had the banks out Friday, JP Morgan, we've just had Goldman, and they're net positive at this stage. Obviously, the earnings don't really encompass the tariff volatility that we've witnessed. So that will be more informed, I would imagine, in the next quarter's earnings. But at this stage, they are providing some support to the market. In terms of market volatility, the VIX is still trading above that pivotal 30 level. So whilst it's above 30, you can expect roughly about 2% moves. We're currently trading 32.82 here in the pre-market. So that basically equates to a 20-day absolute change just under 2%. So you want to factor that into your trading, certainly in your position sizing and risk management. It's important to keep an eye on the VIX, because there's no point using very tight stops when we're trading with a volatility handle above 30. You're just going to more likely than not get stopped out and then potentially see the trade move in your favor anyway. From a options perspective, in terms of gamma, the net gamma position is still negative 1.2 billion. So this can lead again to volatility as dealers and market makers have to chase moves in the market to cover their exposure. We do have monthly options expiration on Thursday this week, and the VIX expiration is on Wednesday. That VIX expiration on Wednesday could lead to some support for the market, depending upon, again, obviously we have event risk from the tariff headlines, but if we can get through to Wednesday, let that VIX contract roll off and expire, and then we can reassess there may be some short-term support there. In terms of the gamma exposure, it's going to take a move through 56.70 to flip the gamma positive. And so those are some factors to consider. Above and beyond that, in terms of the flow side of things with respect to trend following strategies, there's not really much to glean from that at the moment, as we don't see, or according to Goldman Sachs trading desk anyway, they're not going to become buyers at this point given the short gamma environment, and it's going to take the gamma flip to occur for those trend following strategies to engage on the long side. So not really gleaning much support from there. So let's move to the charts and see where we are from a technical perspective, and like I say, identify some potential high probability action areas for the week ahead. On the charts at the moment, you can see my current positions and exposure. I have a long tilt to my book at the moment. These are swing trading positions. I trade intraday, but I try to keep the swing positions updated on a daily basis. So those that are in the trader chat group that I run can follow along and see what I'm doing. If you want to join, I would say the trader chat that I run through a Facebook group for Tickmill, you can email me directly, patrick.munley@Tickmill Partners, and request access, and I can sort that out for you. Alternatively, you can follow along through the Tickmill blog, where I share on a daily basis levels and trades, setups and targets. Also give institutional updates specifically from Goldman Sachs trading desk with respect to the US equity markets. And today's update is the weekly update. So this gives the weekly bull bear zone that I'm looking at. So where I see positive, if we're trading above the weekly bull bear zone, obviously I'm bullish and looking for long positions. If we start to break down below there, I'm going to be, my tilt on the week moves to the short side, and I'm going to be looking for short positions. I have weekly range resistance and support. We'll talk about that in a second with respect to market maker positioning and the anticipated range for the week based on implied volatilities. So from a technical perspective, last week we tested into the pivotal support here at the trend channel on the weekly time frame, or just shy of that. We put in a low of 48.32 before seeing buyers step in. Obviously, the catalyst for that came from Trump himself walking back the tariffs on to a 90-day review period. Every country ex China, and so that led to this rally. The level on the daily time frame here is from the post-COVID lows, which is a 50% retracement at exactly that 48.32. On the weekly time frame, the 38.2% retracement from the 2020 low is slightly lower, coming in at the 46.42, which also coincides with the highs before the last leg to the upside. So that's a level to keep in mind to the downside if we start to see some weakness. But like I say, for this week, implied volatility suggests that 51.40 could act as support to the downside and can be a downside target if we start to roll over. The alternative is 56.40 on the top side, which is weekly projected range resistance, giving market maker implied volatility. I'm using a bull bear zone this week of 5,300 to 52.90 as my guide, really, to momentum to the upside or to the downside. What I would also highlight to you is if we blow up the weekly chart here, you can see that since the high on the weekly time frame, we've traded below the 5-week volume weighted average price look back, which has led to this the decline that we've seen. As of the open, currently, we've still got a couple of hours to go here before the New York cash session, but we are trading to the upside here. We're actually trading above the 5-period weekly volume weighted average price, which comes in 54.20s. So that adds some positivity to the session at the moment. In terms of the daily volume weighted average price, so the look back on the daily time frame, that comes in at 53.20. So I'm using this week a weekly bull bear zone of 5,300 to 52.90. So that's where I anticipate we'll see some support. I would also highlight that the anchored volume weighted average price from the all-time highs comes in, or is currently around the 56.49. You'll remember 56.40 is the weekly projected range resistance. We have the anchored weighted volume average price from the lows coming in down at 52.16. I keep those levels in mind as well as we get into the session. So let's get a little bit more granular and move into the intraday charts and see where the initial trading opportunities are for the week ahead. So we are currently trading at 54.69. I'd be using any pullbacks into our weekly bull bear zone, whether headline driven or just a grind lower to test that area. I'll be watching for bullish reversal patterns there. My principal objective this week is going to be this 56.40. We do have the post-tariff announcement gap down or gap fill at 56.10. So what I'm looking for is any move up into that 56.10, 56.40. I'll be looking for bearish reversal patterns from there to pull back to test into our weekly bull bear zone at the 5300 to 5290. Alternative scenario is that we pull back and test that area before testing the 5640 to 5610. If that's the case, I'm looking for bullish reversal patterns from the bull bear zone to target that upside objective. So those are the two key areas that I'm paying attention to as we start the week, and the two trade zones in terms of swing trading opportunities that I'm going to be focused on as we get going here. Obviously, it is a holiday shortened week, but I'm expecting volumes to probably taper off into the middle of the week. So if we start to see a trending type move today up into that 56.10, 56.40, then that's why I'm interested in looking at short opportunities there, because I think we can start to see a pullback and a reduction in volatility as we head into the holiday extended weekend. So we'll see if we get a trend type move today, and then looking for more of a balancing type action as we head into the middle and back end of the week. Like I say, if you want to follow along and follow the trade setups and the levels that I issue on a daily basis, you can do that directly through the Tickmill blog there. And like I say, you get the levels, trades and targets, and you also get some institutional insights, which certainly in these market conditions are helpful and a good guide as to what the bigger boys are doing. And as always, we're just trying to join their flow, really, as retail and independent traders ourselves. As always, traders, plan the trade the plan, and most importantly, manage your risk. Until next time, thanks very much.